So fundamentals are the cash flows that investments generate. So the way to think about that is if you have, say, a term deposit or a bank account, you get interest on that bank account, and the fundamentals of that investment are the money that you put in and the interest that you get. If you buy, say, a share in Woolworths or BHP as an investor, you get paid dividends, and those dividends are the fundamentals of the investment. So if you want to value a company that pays a dividend, then you look at the dividends that you expect in the future. So when we say fundamentals, what we mean really are the cash flows that you get as an owner of an investment, which is often a company or a share of a company. Fundamentals are important to our investment approach because we like to use valuation to make investment decisions. The price that you pay for an asset should be compared to the value you get from it. As an owner of a company, the value you get is the cash flows that are paid to you as an owner through dividends and through retained earnings. So over time, our research suggests that prices follow fundamentals. So the reason why fundamentals underpin our investment approach is because prices follow them over the long term. And so as long-term investors, that's where we spend all of our time, analysing the fundamentals and working out what we would get as an owner of that investment and what we'd be willing to pay for that. So if you watch the financial news or you read the newspaper, generally there's a lot of talk of what's going to happen to the economy, what's going to happen to interest rates, what's going to happen to the unemployment rate, a lot of questions. And you'll hear a lot of forecasts. People will say, oh, interest rates are going to go up next month, or there'll be a recession next year. And what we find is that actually a lot of those forecasts are very rarely accurate. People spend a huge amount of time forecasting, but generally people aren't very good at forecasting. And so we think where people should focus is on fundamentals and valuation. And we like to think about this as preparation rather than prediction. We don't know what's going to happen tomorrow or next month or even next year in the stock market. But over the very long term, we're confident that prices will follow the fundamentals of the underlying cash flows of the investment. That's where we spend all of our time. Over time, we look at the price that we pay relative to the value that you get as an owner. So what we look at is imagine you owned Woolworths and you looked at the current dividends and you estimated all future dividends and you said, well, what would I be willing to pay for those today? That's the value. We compare the price of, say, Woolworths to the value, and if the price is below the value, we'll buy it. If the price is above, we'll avoid it. Over the long term, our research suggests that buying assets for less than their worth produces better risk-adjusted returns and also a more stable, smoother long-term investment ride.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.